Hello everyone, I'm Noah Lui, RHB Bank's Head of Investors Advisory. Welcome to our Money Chat series. We are at the very exciting time of the technology cycle. Looking at the Nasdaq index, it has reached all-time high, driven mostly by the Magnificent Seven shares. Just to illustrate this, for the past 1 year, about half of the return of Nasdaq is contributed by the Magnificent Seven. How long can this last? And is all mega cap created equal? Today, we are very honored to have Ben Bei, Regional Lead Strategist of the Sector and Thematic Strategy of BlackRock Equity Group based in Singapore. Prior to joining BlackRock, Ben has more than 16 years of experience in financial industry spanning across global and regional financial institutes such as Goldman Sachs, CIMB, and Morgan Stanley. Thank you for joining us today, Ben.
Thank you.
Tech fund has been a very popular investment for Malaysian investors. However, judging from the deeper fund flow report, I do see some investors already taking profit from this sector since Q4 last year. However, some investors re-entered into this market early of this year. It seems like the preference for this sector is they are very cautious, but at the same time, investors do feel that there is upside potential. So, Ben, can you share with our investor, is there a lot of upside potential in the tech sectors?
Yeah, the rally of the Magnificent Seven over the past 18 months are mostly due to the fundamental reasons. Many of them are beneficiaries of the generative AI, which investors saw big earnings uptick already and expect a rapid growth to come. Looking ahead, we expect the rally to broaden in 2024, mainly due to three broadening themes. Firstly, technology fundamentals will diverge and broaden. 3 out of the Mag 7 companies recorded a negative return year-to-date, actually, due to the challenging growth outlook. Instead, many non-Mag 7 companies with direct AI revenue exposure and fast growth rallied and continue to be favored by investors. The potential lower interest rate and the revival of M&A activity, as well as the IPO market, may favor higher growth next-generation technology companies. Secondly, AI beneficiaries will broaden. After the strong outperformance of AI infrastructure stocks such as semiconductors and cloud services last year, the market focus may shift from AI infrastructure to data integration and applications type of AI software companies. More companies will be included to investors' radar and the AI given the trend. Lastly, performance may broaden to non-US markets. Along with the stabilization of currency expectation and the global AI supply chain development, many non-US companies may have the potential to catch up on their performance as well.
Ben, so far we have been very focused on the tech sector in US. What about any investment opportunities in the tech sector of other countries, for example, like in Europe or Japan and also in China?
Yeah, that's a good question. US is definitely still the leader in the tech space, including AI development. However, we do see ample opportunities outside US. Similar to the Apple supply chain, like we saw 10 years ago, there is an AI supply chain in Asia that can benefit from the fast growth of generative AI. For example, many Korean and Taiwan companies contributed many different components in the supply chain, such as AI server, certain semiconductors, and the cooling system, etc. Many of the supply chain companies performed as strongly as the Mag 7 last year. In Japan, we do see high-quality companies in some hardware and semi-components or semi-equipment areas. European companies are quite strong in semi-equipment and semi-components as well, and we do see select high-quality companies there. In China market, investors need to be very selective about the investment targets, as the fundamentals and the policy outlook are both important in this market. One trend we saw from China is to enhance their own capabilities in core technologies, such as semiconductors. Such self-sufficiency effort may bring relevant opportunities as well.
Given the US equity market has recently reached all-time high, particularly in the tech sector, if there is any reversal in the tech sector, how can the investors safeguard their investment portfolio?
Yeah, technology sector has been the best performing sector in equity markets in the past many years. Accumulative, but yet it is still a volatile sector. Investors need to differentiate reversal from pullback or bear market. A pullback is a normal adjustment to a market cycle with no change to the attractive fundamentals. The long-term outlook of the technology sector is still robust, underpinned by those fast-developing themes like generative AI. While it is impossible to be totally immune from the market volatility or pullbacks, high-quality stocks should be more resilient still. Companies without profit or cash flow tend to be more vulnerable in a tough environment. We believe being cash generative is important for companies in current higher interest rate environment. In addition, companies with steady business growth, such as consumer tech, will be relatively more stable in a tough environment as well.
With the upcoming US election and the possibility of an interest rate cut, do you believe this factor will significantly impact the potential of further upside in the US equity market?
Historically, we saw good and bad years in the election cycles, so we still believe it is more fundamental driven. One difference for this year is that we may have two candidates who are the former and current presidents, which in our view can reduce policy uncertainties, as investors have some expectations of their policy direction. Specific to technology sector, we do not expect major policies around or after the election that may pose significant impact to the technology sector. Interest rates, however, are a major factor that will impact the valuation of technology companies. Generally speaking, higher interest rate will tend to curb the valuation of equities, especially growthy companies like tech. So we believe if there is an interest rate cut to come later this year, that should be a positive catalyst for technology. It is still unclear about the actual timing of that, which is heavily data dependent, but the direction of travel is there given the falling inflation in the US in our view. Again, I'd like to reiterate that the global tech is not only about US, even though US is still the largest market. There are ample non-US opportunities globally.
Dear investors, if you have any questions about technology-related investments or any tech funds in the market, you may put down in the comment box below, so we'll try to address your questions as soon as possible. Ben, in Malaysia, we have quite a few types of technology funds. Some of the funds basically are more biased to the bigger cap sector and some to the smaller cap sector. So in your view, do the smaller cap technology stock offers superior total return prospect compared to the mega cap technology companies?
Yeah, it is actually still the fundamentals that drive the stock price in our view, not the size. For tech investors, many people put too much attention to the growth, and it is easier for smaller companies to deliver higher growth than those mega caps. But still, growth stocks are quite diverged among small and large cap as well. Looking ahead, we do see some encouraging signals for small to mid-cap technology companies. From valuation perspective, there is an attractiveness of the small mid-cap tech in the moment. Small mid-cap technology companies saw meaningful derating on average since 2021 due to the rising interest rate, and that has not recovered yet. Such derating is much more severe than large cap to mega caps in the same period, which translates to an attractive valuation for small mid-cap technology companies as of now. If the interest rate is going to come down later this year, smaller cap valuation is expected to benefit more and more sensitive to that as well. From a fundamental perspective, the first batch of generative AI beneficiaries concentrated in infrastructure such as compute silicon and hyperscale cloud, which are dominated by the large caps as well. However, we expect the beneficiaries or benefits of the theme will spread to a data integration, software, and application in coming 1 to 2 years, where we do see many small to mid-cap companies on there are well positioned. Furthermore, given the recovery of the market sentiment, we observed reopening of the IPO market and M&A activities. An active IPO and M&A market may bring more investment opportunities about new and small mid-cap companies.
In investment, we always share with our investor instead not to time the market, but it's the time in the market. However, it's easier to say than done. A lot of investors always try to position whether it's a good time to enter or is it still a good time to hold? So how would you advise our investor that is currently holding a position in the technology fund?
Yeah, it is very good and a tough question. We are long-term investors, so always suggest investors to have a long-term investment horizon. Understand that some investors like to take trading approach, but equity market is very volatile, so time the market is always difficult. Our objective is to generate long-term investment returns across different market cycles for our clients. We are positive about the long-term growth outlook of tech. The sector continues to evolve as technology developments are in every sector, and the next generation of innovation companies are leading the way. Therefore, we can suggest investors allocate a certain portion of their investment to tech as long-term holding, while the percentage of allocation can depend on their own risk appetite and the investment horizon. Tech sector had a good start in 2024, and we see the rally could potentially broaden. Firstly, beyond to non-mega cap. Secondly, beyond to more AI beneficiary groups such as software companies. And lastly, it is beyond to non-US companies.
Thank you, Ben, for sharing your insights today. I'm confident that our investors have gained valuable knowledge on the current issues and prospect for investing in the global technology sector. Given the current market outlook, which expect fewer rate cuts, suggests reduced tailwind for the technology sector and global equity sector to a larger extent. RHB Bank's platform offers a variety of technology funds catering to different investors. This includes a broader mega cap tech funds, style bias tech fund, and regional bias tech fund. Below, I have provided some example of the technology funds available on our platform. As equity market performs differently at different time period, it's important to be dynamic when it comes to asset allocation. For investors who wish to take some profit or gradually reduce exposure in a certain sector, this can be achieved by reallocating to different funds that have similar holdings. By shifting the type of funds available on your portfolio, you can effectively reduce exposure in a particular sector. For example, investors who are holding technology fund may reduce overall exposure by shifting into global equity fund, while investors can further reduce exposure by shifting into a global mixed asset fund, where only part of the equity exposure in the mixed asset fund has exposure in the technology sector. Another asset allocation strategy that investors can consider is reallocating to different investment styles. Recently, we have noticed a broadening of growth within the technology sector, extending beyond the large market cap. Equity market rally has broadened where index such as S&P 500 has performed better than Nasdaq on a year-to-date basis. Investors can maintain its overall technology sector exposure by reallocating to different type of strategies such as technology fund that focuses on a different market cap or technology stocks in a different region. It's crucial to assess your investment portfolio comprehensively to have an overview of the see-through sectoral exposure within your investment portfolio. Please engage our relationship manager and investment specialist to see what type of fund is suitable to include in your portfolio, as it may differ depending on your risk profile. See you again in our next Money Chat series.